Welcome everybody to our webinar. We were recently in Solista physically, and we had a seminar. We had a great turnout and answered a lot of great questions. My name is Reno Beninati. I'm joined by my colleague Ken Crown and Christine Fata. Christine will be the moderator and host of the webinar. And just a little background on us. Greenspan has been in business 77 years, 78 years now, since 1946. And our function is to prepare, present, negotiate insurance claims. As the years go by, we see more and more of these catastrophic events. Ken and I have been involved in pretty much every wildfire in recent history. From California, certainly up to Washington, and of course now in Canada. I am licensed in over 22 states in the United States and British Columbia as well. Ken probably has the same amount, if not more. I have been a public adjuster now for 30 years. Ken is doing it 39, I think 38 or 39 years. So between the two, certainly we've got a lot of experience, almost 70 plus years in the business, and have seen a lot of claims, have fielded a lot of questions. And so tonight we wanted to talk about what it is, how a policy actually responds to these losses. They're complicated. Your policy is now a contract, and it's subject to the contract language. It was a policy until you activate it with a claim. Once the claim gets opened up, then it's subject to this contract language. And we're going to go through the different types of claims on an average homeowner's claim, fire claim. And these slides will be pretty detailed, and we will field questions as they come up. As Christine had mentioned, please feel free to raise your hand or put something in the chat, and we will try to do our best to get to all those. So first slide here is the overview of the claims process. Basically, most people who do file a claim, they don't know that they are now a claimant. As simple as that sounds, the insurance company is not the claimant. You're the claimant. And just through the word itself, you're staking a claim for money under this contract of insurance. Now, there's no law in anywhere that we have been licensed in that says that an insurance company has to be accurate on their measurement of the loss. The duty to perform is on you. You're the claimant. You're making a claim for money. And so the burden of proving what those damages are falls upon you. That's what we do. We're licensed and bonded to prepare, present, and negotiate the insurance claim professionally. The way we measure them are very detailed in a forensic level, which allows us to certainly collect a lot more money than you would be able to on your own. There's a lot of different negotiations that happen, small ones, big ones, and everything in between during the claims process. So again, to just allow an insurance company to come in and measure your loss, well, it's an inherent conflict of interest if you think about it. They're holding the money and they're going to tell you how much they want to pay you. Remember, it's an opinion. Their offer is always what they think they owe you, and until you prove to them why they owe you more, you're going to be in a situation where you're being proactive versus reactive. We're all about being reactive. So these claims are large. There's tens of thousands, hundreds of thousands of dollars at stake. So tonight's webinar will hopefully educate you, put you on the right track. If representation makes sense, certainly we can talk about that, and we'll be able to make appointments, phone appointments, video appointments, physical appointments, and what have you. Be happy to do that, to discuss your particular issues and claim. Christine, let's go to the next slide. So this, Kenny will introduce this slide. Kenny?
Sure. Thank you, Reno. Wendy Jobs was a client of ours. I met her a couple weeks after her home burned down, Boxer Day back in 2021. She had just got done building a custom home next to her home, was getting ready to move in. Unfortunately, it burned to the ground. We met a couple weeks after the fire. She didn't know about public adjusting. She was having some issues already with her insurance claim. One of the big issues that came up was because she was planning to move into the home, but she still had her old house. The carrier wanted to not pay her for any living expenses. And then when they offered her, I think, $3,000 for what her 4,000 square foot plus home would rent for, obviously it was substantially more. And we ended up doubling that monthly rental value. We also put forth a very detailed documented building claim, which the settlement ended up being almost double what her original reconstruction costs were. We're finalizing her personal property claim, and she wrote this beautiful testimonial, and we decided it would make sense to put it to video. So we can play that for you now, and she'll be available to answer any questions specifically. Having someone firsthand go through this process, she can certainly relate to what you're going through now, and in turn, you'll be able to relate to what she went through. Go ahead, Christine.
Wendy Jobes wrote us a powerful testimonial, and we asked if she would record it for us. Hear what one of your neighbors has to say.
Hello, my name is Wendy Jobes. I want to share a personal story that happened to me and my family. It started with a devastating event. In December of 2021, my family's home was engulfed in flames in West Kelowna on Boxing Day, just shortly after we had moved in. I assume that if you're watching this, you have experienced such a tragedy. You know the feeling, the peace and security of your home gone in an instant. No one can truly ever prepare you for this. The emotional toll was overwhelming. Unfortunately, our dealings with our insurance company only increased our anguish. It felt like we were navigating an industry that prioritized profit over helping us through this disaster. The only compassion we seemed to receive was in their advertising. But then something remarkable happened. We discovered and found Greenspan Adjusters International, or as they're curiously known as public adjusters. They're experts in their field, and even though they are relatively new to British Columbia, it was clear that they were here to make a difference. Greenspan became our guiding light through the darkness, and everything Ken Crown promised his team delivered over and over again. They took charge, offering unwavering support every step of the way. They weren't just strategic, they were strategic for us and our own personal situation. They never gave up, they advocated on our behalf with unwavering determination. This team includes adjusters, forensic examiners, and inventory experts, and it was nothing short of remarkable. Thanks to their expertise and relentless dedication, we found peace of mind amid the chaos. We are empowered to rebuild our lives as well as our home. As wildfires rage across our landscape this summer, I felt compelled to share our story and our family's journey to help you, my neighbors, and my community. Today, I'm delighted to report that thanks to Greenspan and the team, we are well on our way to rebuilding our home and life as we knew it. They're the real deal, folks. I encourage you to lend them your ear, be open to what they have to say, and consider them partners in navigating the complexities of insurance during challenging times. So I wish you all the best of luck.
Ooh. No matter how many times I look at that or watch that video, it really rings a bell. Thank you, Wendy, for doing that. So first slide, folks, we're going to talk about the policies. As you're well aware, now I'm hopeful that everybody has a copy of their policy by now and a certified copy, or at least the whole comprehensive copy, which could be anywhere from 30 to 80 pages deep, if not more. It's the actual contract language which is needed, because if an adjuster is quoting something or interpreting the contract and you don't have a copy to reference, you're going to be at a disadvantage. So we urge you strongly to get a whole copy of the policy. We met somebody recently who didn't even have a copy after 2 months. So request it from the adjuster, from the underwriting department. Usually takes a couple of weeks. It's a certified copy, and you got to have that. That's the rule book. And if you don't have the rule book, folks, you're not in the game. Very important. So let's jump in. We're going to talk about the summary of coverages. By now, you should have a good idea that the policy breaks down into 4 categories, A, B, C, and D, as you see it on the screen. The dwelling consists of that's the big one. That's the meat and potatoes. The structure of the house. It'll cover things like limit amounts of insurance, guaranteed replacement cost. It'll talk about debris removal, landscaping, inflation, et cetera. So under the bucket A coverage, there's a lot of sub coverages on these. So these are the 4 main coverages. And then below those, there are other sub buckets of coverage that you want to tap into. There are qualifiers involved, and it's a little complicated, but after this evening, you should have a better idea of how your policy responds. So A is the dwelling. That's the big one. B is detached structures, things like retaining walls, anything like a garage or a workshop. A lot of these rural areas, we see a lot of workshops out there, big ones, and exterior sprinklers, exterior lighting, things like that. Anything that's detached from the main dwelling would be considered another detached structure and covered separately. Each one of these buckets are covered separately. They have to be prepared separately, and they have to be negotiated separately. And so it's important to understand how one doesn't really take away from the other, so to speak. They're all separate, and they all have their own separate language. C is personal property. That's the big one. If you took your home, your sheds, your outbuildings, your workshops, and you before the fire, and you tip those buildings upside down and shook them, whatever falls out would be considered your personal belongings. There are special limitations on some of the personal belongings, like business equipment, that we'll talk about, and things like rider mowers. Every policy is a little bit different. Motorized land vehicles can be excluded unless they're used to service the land. So we'll get into the mechanics of the personal property. I always like to say on that one that if that's not handled right, it'll take years off your life, and it's just a really tough bucket of coverage to go through. The next one is loss of use, and that talks about your temporary housing money. A lot of you don't realize that there's a lot of benefits there that can be had. And oftentimes the insurance companies don't really volunteer to give you all the information so you can make good decisions for your families on how to live in your same standard of living that you had before. So we'll be talking about these all separately again. And then there's the declaration of emergency endorsement. Those are for when you get evacuated and you go back in. There's some coverage there for a limited time for you to stay in a hotel. Okay, let's move on to the next one.
Sorry. It keeps wanting to go back to, just 1 second.
Marty Jobes wrote us a powerful.
Okay, so Kenny's going to talk about this slide. This is got to do with a single limit amount and guaranteed replacement costs. We're seeing a lot of policies here with either or both of these benefits. It's a little bit complicated, so hopefully you can follow along. I think, Christine, if you don't mind, with the pointer, as Kenny's explaining the slide, can you kind of follow along with the bouncing ball, so to speak?
Yep.
It's all yours.
All right. Thank you, Reno. Just one thing I was going to add to what Reno talked about as far as understanding your policy and reading it. There are times where we hear people, policyholders tell us that our insurance adjuster has told us it's not covered under the policy. And one particular issue was they didn't pay for the cost to rent furniture for a home that was unfurnished. And so our line of thinking is, tell us where in the policy is it not covered. And so you're going to run into situations where the carriers or the adjuster or the independent adjuster is telling you something's not covered. Ask them where it's not covered under the policy. That's important. This example here is a typical policy, Intact, and many of you may have Intact. They're one of the larger insurers here in Canada. In this scenario, coverage A, which is the dwelling, whatever that dollar amount is, coverages B, C, and D is typically a percentage. So in this example here, we have dwelling coverage with limits of $1,200,000. And again, that covers the house, not the contents in the house, but the house itself. Detached structures, as Reno mentioned, would be anything that's not attached to the house, driveways, walkways, barns, detached buildings, sprinklers, pools, by the way, are typically not part of detached structures. They're part of the dwelling, but detached structures would be everything else. In this scenario, it's 10% of the dwelling limit, $120,000. Sometimes the coverage is 15%. It varies. Personal property, which is everything that's in your home. If you were to turn your home upside down, anything that falls out would fall under personal property. Typically, that's either 75 or 80% of the dwelling limit. In this example, it's 75% of the dwelling limit with limits of $900,000. Loss of use pays for any additional living expenses you incur, or if you were renting out your home or a portion of it, it would also be covered under loss of use for the loss of rents. In this scenario, it's 20% of the dwelling limit, $360,000. Now, most policies in Canada have what's called a single limit amount. And it's kind of like having blanket coverage. You may end up having a shortfall in your dwelling coverage. Maybe to rebuild the dwelling is $1,400,000, but your personal property losses may only be $700,000. What the single limit allows you to do is to use that total amount of $2,580,000, which is the combined amounts of coverages A through D, and then you can decide how you want to use it. If you have losses greater than on the dwelling of $1.2 million, but you're not using all of your loss of use monies or all of your personal property, you can apply it any which way you want. And that's a nice benefit, because a lot of times you may not have quite the right coverage for your detached structures or for your dwelling amount. So that's how single limit works. And we'll take obviously any questions right after this slide. Now, in addition to single limit, most policies in Canada have what's called guaranteed replacement costs. And basically what that pays for is the cost to rebuild the home, whatever the agreed upon replacement cost is. And sometimes, especially in firestorms, the cost to rebuild the home is a lot higher than the $1,200,000 limit. And it may just very well be that if all the losses combined are greater than the single amount limit, because instead of the dwelling costs costing $1.2 million, maybe the dwelling in this scenario, the repairs are $2 million. Well, don't worry. If you've got guaranteed replacement costs, they'll pay whatever the agreed upon replacement cost is for the dwelling. So in this example, instead of the dwelling repairs costing $1 million or 1.2 or 1.5 million, it's now going to cost $2 million. And of course, you're going to opt for the guaranteed replacement cost coverage, because your losses combined for everything will be over the $2,580,000 amount. So in that scenario, the single amount limit of $2,580,000 is reduced by the dwelling limit of $1,200,000. And the balance, which is $1,380,000, is the remaining amount of your single limit coverage, which is applicable to whatever your losses are for just the detached structures, the personal property, and the loss of use. And it's still a blanket coverage, and you can use it any which way you want. Then you get to collect for the guaranteed replacement costs on the dwelling. In this scenario, it's $2 million. And so now your combined coverage amounts is $3,380,000, assuming you use the full $2 million under your guaranteed replacement cost, and you exhaust the remaining single limit amount between the detached structures, personal property, and loss of use, which is the $1,380,000. Now, I realize sometimes it's a little hard to follow. So if there's any questions, Christine, if we have any questions, we can certainly field them now.
If anyone has any questions, you can use the raise your hand button, or there's this chat over here as well. Oh, okay. Just one sec. I'm just going to allow you to talk, Allie. Go ahead.
Okay, so I'm one of the people that has the guaranteed replacement cost coverage. I do not have the single amount. So can you explain that one more time? Because I'm a little lost at how you come to the 1380 or million three and change.
So if you don't have the single amount, you can just ignore that.
Okay.
And so under your policy, and who are you insured with, by the way?
Intact.
Intact.
Yeah.
Well, you may, if it's a residential policy and not a rental property and not a farm policy, you should
have seasonal property. Sorry to interrupt.
Yeah, that's why then. That's why. So the seasonal, they offer guaranteed, they don't offer the single limit amount. So in that scenario, you're limited to the, in this example, for detached structures, 120,000, for personal property, 900,000, for loss of use, $360,000. But the dwelling amount, if it costs $1,500,000 to rebuild the building, that's what you have coverage for. It's whatever it would cost that's agreed upon. You got to get the insurance company to agree to it. That's a whole nother matter, and we'll talk about that later on. So guaranteed replacement costs will basically pay for whatever it costs above the stated $1,200,000 limit under this example. So if whatever your dwelling limit is, if it costs more to rebuild, you're covered for that. But you got to be a little careful with the guaranteed replacement cost endorsement. There are requirements for that coverage, and we might as well talk about it now, Reno.
Yeah.
And that is that with Intact, if you've done any upgrades, you've added on to the house, you spent upgrades in 1 year that were greater than $30,000, and you didn't report it to your agent or to Intact, then Intact can say, look, you had an obligation to report that. You've been paying less of a premium, and they can not provide the guaranteed replacement cost coverage. If you look at it, there's like 3 provisions in it. One, if you've done any major upgrades more than $30,000 and not reported it within a stipulated time frame to the insurance company. The second requirement is if you're initially taking the policy out, they will request an appraisal that you secure, or they'll do their own. And it has to be an acceptable appraisal. And then once they accept the appraisal, then they've determined what the replacement cost value is. And the reasoning behind all this is they want to make sure that if they're going to give you guaranteed replacement costs, you are paying a premium and having coverage that reflects truly what it would cost to rebuild your home.
On top of that, yeah, I'd like to add on to that. So back to the qualifiers, Allie, and all of those that have guaranteed replacement costs, these qualifiers are very, very critical. One of the first questions the adjusters will ask you is, have you done any work on the house? And of course, you want to get paid for it. And so you'll say, yeah, I put in a new kitchen, new baths, and then you got to be careful there. There's a difference between betterments and improvements and maintenance on a house. And so you got to read that qualifier and be very careful of how you answer those. The other one that Kenny was talking about, just to elaborate a little more deeply on it, is you need to have it insured at the time of the loss for 100% of its replacement cost value, not the land value, just the building, the dwelling. And so these qualifiers are very critical in an effort for you to get that benefit, guaranteed replacement cost. You have to qualify. Remember, you've got obligations to meet, and the insurance company has obligations to meet. And as long as you're operating within the four corners of that contract, you're fine. So just be very careful out there, guys, on how you answer the questions. They're very scripted. The adjusters are asking very scripted questions, and unless you understand why they're asking the question and how it's going to affect your settlement, you're better off just having them email you the questions so you can study them and answer them appropriately, understanding those two components of the why and how. Very, very critical.
It's a good point, Reno. And just so everyone knows, it's really important to be aware that if they ask you, well, what remodeling did you do? And maybe you spent $40,000 or $50,000 in remodeling your kitchen. One could suggest that what you did was somewhat maintenance related, because if you went back with the same kitchen you had, so for example, if you put in granite and you had Formica, well, granite's more money. That's part of that upgrade. That would be part of that $30,000. But sometimes a lot of people just replace carpet with carpet. If you replace carpet with hardwood flooring, maybe the increased cost is the differential price between carpeting and hardwood flooring. And many times, when this issue comes up, we want to separate out with the carrier. But no, they didn't really spend $30,000 in upgrading what was there. They spent the differential with the increased material costs. Does that make sense?
And you'll find that language under basis of settlement. And that's a really important area of the contract, because they're telling you that's how they're going to pay, and if they owe you the money, these qualifiers are in there.
Any other questions, Christine?
Yes, Anita actually has one. Just one second. Go ahead, Anita.
That answered your question, Allie. Hi, Anita.
Sorry, Allie, did that answer your question? Oh, she's muted. Okay. I think she's okay.
Hi, Anita. How can we help you?
Oh, she's muted.
Yep, you have to unmute.
Oh, there we go. Sorry,
There we
I thought I unmuted, but I must have muted myself. Thank you. So I don't see either one of those questions or one of those terms as far as like single, whatever you said, a single amount limit or the guaranteed replacement cost. What I do see, I have a manufactured home insurance policy, and what it says for my building is actual cash value.
Okay. Kenny, is it okay? I think that some of the summary pages or the declarations pages don't actually talk about single limit or guaranteed, but it'll be in the body of the contract, right?
Yeah, but with manufactured homes, it's almost
Right.
like a mobile home. Many of them, Reno, are not insured at replacement costs.
Right.
And what actual cash value means would be the cost to replace less depreciation. There's on some of the policies, they refer to market value, but typically in Canada, it's the cost to replace minus depreciation. So what that means is whatever it costs to replace that manufactured home, they are entitled to pay a depreciated value to take into account if the roof was 10 years old and it was a 20-year roof, they're going to want to depreciate the cost of the roof replacement by 50%. And they'll do the same thing for windows, siding, etc. Now, we always like to argue that, not everything depreciates. Framing can last a couple hundred years. Concrete can last, 70 to 150 years. And maybe you should only depreciate the material component of a particular trade because labor doesn't typically depreciate. So when you're negotiating with the carrier depreciation, you may want to throw out there that well, look, the framing's going to last forever. Why are you depreciating that? We always like to take the position that the only thing that should be depreciated are finishes that you would normally replace in a given 20-year life cycle. You know, floor coverings, wall coverings, roofing, appliances, things like that.
And if you've replaced those in that time, like since the,
Well,
like in,
yeah, under your policy, if it's truly an actual cash value policy and you don't have replacement costs, you are not going to collect replacement costs. You will collect the actual cash value of the cost of repairs, which is going to be replacement costs minus depreciation.
So where you'd find that, Anita, is under basis of settlement. You got to go to that section of the policy and find if in fact that they only owe actual cash value. I've seen a few, Kenny, manufactured home policies, but they do pay, some of them do pay actual cash value and some pay on a replacement cost. So Anita, who are you with on that policy?
I'm with Agile.
Okay. Yep. All right. So that's where you'll find it. And so again, that's really important because the negotiations are a little bit different. The strategies of negotiating down the depreciation, minimizing it is really important so you can get more money up front.
Yeah. And Anita, look at your declaration page. That's the page that will have the amount of coverages for your dwelling, for your detached structures, for your personal property, for your living expenses. And it may have like replacement costs, and it may have a box that's checked off. Well, that means you have replacement costs. And so that's what you want to look for.
Okay, thank you.
You got it. Let's move on to the, is there any other questions?
Yeah, so there is another question here.
Okay.
Kayla, raise your hand if you do want to talk. If not, I'll just get the guys to answer because she did put it into the chat.
Oh.
So it says, once an insurance company has made a decision not to cover X, Y, or Z, is there an appeal process available? After how much time? I'm advocating for 67 property owners who have been affected by an overland flood. Overland flood debris is not covered by insurance, or that is what has been stated. And many people have had to rebuild at their own cost at current standard due to policies and or stipulations.
Kenny, you want to take that one?
Yeah. Yeah.
Sounds like an exclusion issue.
Yeah.
And by the way, if you're being quoted by the adjuster, that exclusion, I'll let Kenny elaborate a little more, then you should have them show me in the policy where it says that. Always refer back to those lines. Show me in the policy where it says that. Because remember, the policy, the contract is subject to interpretations and people make mistakes.
Yeah.
Go ahead, Kenny.
Yeah, I'm assuming this is from the major floods that occurred about a little over a year ago. If I'm not mistaken, year and a half ago. I think it was in November, actually.
Feel free, Kayla, as well to write if yes or no to the questions if you feel more comfortable.
Or to speak up, or to speak out. So a lot of homeowner policies do have overland water coverage. Some do not. If you do not have coverage, if it's not stipulated in the policy for that coverage, then it means you don't have it. However, all these carriers are obligated to specify, and they'll usually send out a form letter or a formal letter, and they'll attach the policy provisions saying, you know, your loss is not covered under section such and such of the policy. And usually they're going to have a list of exclusions. And the only way to get around that exclusionary language is if you have what's called an endorsement for overland water. And some of the carriers do offer it. It's like a rider where it basically provides coverage for the dollar amounts being claimed. Sometimes the overland water coverages don't provide single limit or guaranteed replacement, but they do provide coverage for the amounts that are covered under the homeowner's policy.
Okay. She's okay. And then I have another question from Denver. Denver's question is the inflation rate set in stone? Ours is based on the national rate of around 3%, but BC is closer to 10%, which, yeah. As a resident, I get this.
Are we talking about the inflation protection or inflation guard? Is that what she's talking about?
Yes, I believe that's what Denver is talking about.
Most of those policies are tied to the consumer index. Some are at 8%, some are at 6.9%. Sometimes some of the policies will stipulate the actual percentage that they're basing it on, and others are rather vague. So if the question is, what is the number? Then you'd have to find out what the consumer index is and when does it apply? Go ahead, Kenny.
Yeah. So I think what she's referring is, so some of these policies, Rena, they're vague and they said whatever the inflation rate is. Now, some of them are tied into the builders consumer price index. Some of them are tied to the national, which is always a problem. Some of them are tied to the regional, like in here it would be British Columbia province. So some policies specify exactly what it's tied to. Others, it's just typically the consumer price index. What's important, and it seems like she understands it, but most of these policies do have inflation guards. And here's the important matter. If you have a loss, typically what happens is your limits on the declaration page will actually be higher, especially if the loss occurred 6 or 9 or even 11 months and 15 days after the policy was renewed, because that whatever that inflation rate is, the limits are reset. And it's important to know that if for whatever reason you don't have guaranteed replacement costs or your single limit isn't quite enough, at the date of the fire, if you have the inflation guard, your limits need to be reset based on whatever that inflation rate is and what amount of proration, meaning the amount of days or months that have passed from the time the policy was actually taken out.
Any more questions, Christine?
Kayla actually just had a quick follow-up question in regards to the flood one. And it was just, she said, is there an appeal process available? And after how much time?
Kenny, I assume that's the appraisal process, but the appraisal is obviously if it's a covered loss and there's a dispute.
Yeah. So there's what's called, they call in Canada, is called dispute resolution, which is very similar to appraisal, but that is when there's a dispute on dollars. This is the coverage issue.
Right.
So I don't think it would be something that would fall under dispute resolution. You probably would have to hire an attorney. Maybe he could find coverage for you. And maybe you've already spoken with an attorney, but this would be something that would be outside of a dispute resolution or the appraisal process, because it's a coverage issue. It's not a dispute on dollars and cents.
Any more questions, Christine?
No, looks like that's it. So what I'll do is I'll actually, if anyone raises their hand, we'll stop for questions. If anyone wants to talk, and then everyone else, just feel free to put questions into our Q&A, because then at the end we can actually just start going through all of them, because some of these questions we might be answering as we go along here too. But feel free, put a question in the question and answer box, and we'll make sure that we get to them at the end altogether.
Okay, let's move on to that other slide, Christine. Cover J. Okay, so back to the slides. The meat and potatoes bucket, the dwelling breaks down like this. These are your sub buckets under the main bucket. Of course, we're going to stay on that $1.2 million limit. That's just an example number we use. And so what you're looking for is inflation protection of what we just talked about, increased dwelling protection. These are the guaranteed or single amounts of insurance. Some of them are tied to a percentage, some are not. The guaranteed replacement cost endorsement, obviously you want to look for that. Bylaw coverage we haven't talked about. So bylaws are coverages. We're seeing an average of about $30,000 is what we're seeing as a limit. And what that covers is the difference between what you had at the time of the loss for the dwelling and what it now costs to bring it up to code, to today's standards. I believe we're at a step 3. We'll probably be heading to a step 4 by the time you rebuild. And the bylaws coverages, that sublimit, pays for that differential. I'll use a quick example. Let's say you have, at the time of the loss, you had a single pane window, and that window today to replace would be $500. But it has to be brought up to code, right? So the new, meaning double pane window, certain kind of R rating insulation, et cetera. And the new window would be $800. So the differential of the $300 would come out of the bylaws coverage. So remember, they owe you for the as was plus the amount it will cost to bring it up to today's code. And that's covered under the bylaws section. So make sure you find that in your policy. Again, most policies are providing 30,000. We see some with 10, some with 20. And so it's important to find out what that is, because you may have a shortfall, hopefully not, but that's how the bylaws coverage works. Debris removal is a big one. And the way debris removal works as a benefit, debris removal is part of reconstruction. So it's part of the 1.2 million in this example. And the only way that it opens up as an additional coverage generally is if you're able to breach the limit, the base limit of the dwelling, then it opens up that door to the debris removal benefit. So you have to trigger it. It's not just available. Again, it's built into the 1.2, the debris removal is, until you breach the 1.2. And once the damages are measured, that's definitely over 1.2, then you're able to collect up to an additional 5% for the debris removal. Did you want to add on anything to that, Kenny, as far as debris removal?
No, but that sometimes with some policies, it's not just the debris removal for the dwelling. You, depending on how the policy reads, it can be the debris removal for detached structures. It could even be debris removal for personal property. If you've got certain limitations for debris removal, but you have that 5% and it says 5% of the covered amount, the covered amount is the dwelling, the debris, the detached structures, and the personal property.
There's also another benefit, a sub-benefit that you'll see on your summary page, and some policies have it, others don't. It's called mortgage clause and protection, mortgage protection. The way that works is if your mortgage, your outstanding mortgage documents, the application, the stuff that you signed to acquire the mortgage, has a clause in there that if there was a catastrophic loss, they may have the right to call the whole note in at the time of a settlement. And so if that happens, and they're right that it's in the clause, the catastrophic loss clause of your mortgage documents, and they do end up calling your note, well, you pay that off, but now you're short money to rebuild. So you're going to have to go out and take another loan out. And of course, right now the interest rates are horrible. And so the difference between what you were paying in interest, which might have been 3%, for example, and now it's 7%, the mortgage clause protection will pay the differential of that. And that's a great little thing to have. Very rarely do we see mortgage companies calling the note when something happens, but it can happen. So you want to see if you have that benefit built in. Okay, any questions so far on that slide?
Reno, why don't we talk about a little bit about the mortgage companies and checks?
Sure. Yeah, I'll do that. Yeah, so thanks, Christine. You want to just stay on that one? That'd be great. For those that have an outstanding note, a mortgage, the bank, the mortgage company, has what's called an insurable interest in your settlement up to the outstanding note. So why are they going to be named on the check? Because they own a piece of that house with you, and their equity is now gone. And it's so for them to protect themselves, they put their name on the policy, on the contract. And so the way that works is when the settlement comes in for the dwelling and other structures, you'll notice that your name is going to be on the check and the mortgage company's name. This is very important information. You might want to write this down. It's critical. You have to notify the loss draft department at the mortgage company. It's a little department in every mortgage company, and their sole function is to take those settlement checks, whether it's a fire, a flood, an earthquake, whatever is covered, and to get those checks into an account And then once that check clears, then they'll feed it back to you, but they only feed it back to you in thirds. They're able to control the amount of the outstanding note. So we'll just use an example numerically. Let's say you have a $1 million settlement, your name's on it, checks, the mortgage company's name's on it, you sign it, goes off to lost draft department. Lost draft department will put it in usually a non-bearing escrow account, and it sits there until you provide them with a couple of documents. And the first document is usually the adjustment figures. They're going to want to know how these numbers came to be. And they're going to also need a licensed contractor's contract. Who's going to rebuild it? Remember, they've got a liability out there as well. Now, the question I would have is for them is two questions, and this is what you want to ask the lost draft department person, whoever you are talking to. Number one, what is the protocol to release the funds that are unencumbered back to me? So I have a $1 million settlement. I only owe you guys 500,000. You shouldn't be able to control the other 500,000. So when do I get that money? That's very important. That's liquid money. That's your money. It's unencumbered. Unless the mortgage documents say that they can control the whole amount, then you should be able to have that money sent to you right away as soon as that check clears. And then the difference, the other 500,000 in this example, is held onto in this escrow, non-bearing escrow account, and they usually feed it to you in thirds. Now, every mortgage company's protocols are different, so it's incumbent upon you to call lost draft, report that you've had, the house is gone, or you have damages, and find out from them what it is their protocol is so that you can get this money in and out of that account in an expedient manner, because you don't want it holding up the construction. And you want to also, this is very important, you want to make sure that the correct mortgage company's name is on that summary, because I can't tell you how many times the mortgage companies sell the note to some other company and it never gets changed on the policy. And it's like an act of Congress to get the insurance company to cancel the check, and then you have to reissue another check. It's a nightmare. So again, you want to be proactive, not reactive. Again, notify lost draft.
Thank
Any
you.
questions on that process?
We
Um,
do, looks like there's a question here really quickly from Anita. I think,
Yeah, I see the questions too. There's two, one from Kayla, one from
yeah,
I'll answer Anita's one. The question is, I did not lose my house, but I did lose my shop. Does debris removal only come into play if I lose the house? You got to look at the policy. Typically not, but your limitation for debris removal may be based on a percentage of the shop, meaning, and what I mean by that, this is important. So if the shop falls under what's called detached structures, there'll be a limitation. And the example we gave was, let's say the coverage is $120,000. That $120,000 would pay for the cost to rebuild the shop, as well as the cost to remove the debris. But what if the cost to rebuild the shop is $150,000? Well, you only have $120,000. If the loss is greater than the limit, some policies, as Reno mentioned, will have a kicker like 5% extension when the loss exceeds the limits for debris removal. So you would have, in that scenario, if it was $120,000 in coverage, you'd have an additional $6,000 towards the debris removal expense, plus you'd get paid your limits. Does that help out? I think that was Anita. Did that help?
yeah.
Yeah. Thank you very much.
Okay.
On the next one, I'm a little confused on how it reads. Does the bylaw coverage include cost for new, I'm not sure what that is, riparian zone requirements?
I
Can
know
you,
what that is.
okay, why don't you jump
Yeah.
in?
Yeah, it's
So I'm pretty sure I know what it is. Reno, remember the Sprouts claim? They were right on the lake.
Oh, right.
And I think,
Facts.
yeah, it's, and by the way, that's the big problem with bylaw coverage. unless you have a additional coverage, which would be stated on your declaration page, most policies only cover you for up to $30,000. And a lot of these homes along the lake had to have environmental impact studies performed. They had to have the houses set back further. Very expensive process. That is covered under bylaw, but you're probably going to exhaust it if you only have the $30,000 of coverage.
Also, does it cover the structure without a foundation and built before 67 with a new up to code foundation? Yeah, if the foundation's been spalled, or if you don't have a foundation, you're not going to be able to build a new property unless you put a foundation on it. So that's going to be a code requirement, if I'm reading this correctly.
It should get covered. Carrier may say, oh, well, you didn't have one to begin with, and it wasn't to code. And then the question is, well, back before 1967, did they require it? And if they didn't require it, then I think you could get it paid for under bylaw coverage. But again, it really depends on how much coverage you have.
Christine, any other questions?
No, I think Kayla, that was just with Ken. That was in regards to the pledge. She said they're not looking for new coverage. They're looking for recovery.
Okay. All right.
All right, let's move on to the next slide.
Okay.
This is coverage B, detached structures. Ken, you want to take this one, or? That's me, actually. I got it. So this is a really simple one. It's anything that's detached. Now, for those of you that have large acreage, fences always come up as an issue. There's typically exclusions. If you've got miles of fencing, they usually do exclude that. You want to read that. We get calls on this stuff all the time. If you're in a big prairie or a big pasture, and you've got lots and lots of fencing, sometimes that is excluded. Detached garages, sheds, barns, guest homes, patios, driveways, walkways, patios, things like that. A lot of people don't realize that that's part of detached structures. And so if your driveway is paved and it's spalled, or it's damaged, or it's going to get damaged during the reconstruction, then this bucket of coverage will cover that. This 120,000 simply represents 10% of the 1.2 million base limit. Also, debris removal should be covered. Again, as Ken mentioned, look at the policy to make sure. Because the debris field is not just the dwelling, it's also the contents. It's also the other structures and around the property. So this one's pretty simple. Another question we get often, and Kenny, you can talk about it quickly, is the septic system.
Sure. And sometimes wells as well. In the States, sometimes a septic system can be either dwelling or detached structures. Same thing with a well, but typically a septic system and a well, it's used to service the dwelling, and it's attached to the dwelling vis-a-vis utility lines. It really is part of the dwelling, and you want it to be part of the dwelling, especially if you have limited coverage for detached structures, but you have guaranteed replacement costs for the dwelling. So typically anything that is used to service the dwelling, like a septic system or a well, it's covered. Now, interesting enough, and might as well bring it up, Reno, a lot of these septic systems, we understand, some of them are 30 years old, and because of that, we end up running into situations where they've got to replace the septic system. And so is it covered under the dwelling? Is it a code upgrade? If it's not damaged, but it has to be upgraded because there's been bathrooms added or bedrooms added and it's not the code, that falls under bylaw. So you want to make sure that, there is damage to the septic system. And obviously, if there is damage to it, then it doesn't fall under bylaw, it falls under the dwelling coverage. Now, it may have to be upgraded because it's not current. Well, that upgrade cost is what falls under bylaw. So if the septic system is damaged and it's $30,000 to put back the one you had, but now it's got to be code compliant, it's $50,000, then that incremental $20,000 increase in cost is what falls under the bylaw coverage.
I've got some questions here. Dale Jones, what about a CCAN on the property for storage? Is that considered a detached structure?
Yes.
Okay, that's your answer. And Kayla, insurance says they do not cover overland flood debris, and the landholder is responsible for the debris removal. I'd refer back to the policy. Show us where it says that in the policy. And always remember it's a contract. So if you got to have that policy, and you got to refer back to the exact paragraph, the subsection, wherever they're talking about this specific debris removal for overland flood is where you're going to find that language. Insurance can say what they want, but remember it's a contract and it's subject to interpretation. We often find the adjusters, make mistakes or they're interpreting it incorrectly, and it's normal. So you want to be, it's buyer beware. You bought this, or your friends, your clients have purchased a contract hoping they never need to activate it, but now they do. So it's important to understand how that reads and how it applies. I hope that answers the question. Next slide. Personal property. Again, I'll repeat it. This particular claim can take years off your life. Personal property is one of the most arduous claims that you can put together, that we put together when we're professionally representing clients. It's very taxing. It's very time intensive. It takes a lot of resources. So if you took your sheds, your outbuildings, your dwelling, and you tipped it upside down and shook it, whatever falls out would be considered your personal belongings. Personal property is just that. It's personal. And it comes with a lot of sentimental thoughts and values. And most people devalue their personal property. And so the insurance companies like to give you this form or this page, and they say, just fill it out and send it in and we'll price it. Well, that's a big mistake. You never want to let an insurance company value your stuff, because they don't have to be accurate. There's no law that says they have to be correct or accurate on their offer of settlement. Again, it's merely an opinion of what they want to pay. So most homes have about 3,000 to 6,000 line items of merchandise in them, depending on the size of the home, certainly. There's other areas of coverage under the personal property. You have scheduled items, things like jewelry we see, or collectibles, things like that. Those are called scheduled pieces. And so you have sublimits, just like you do on the dwelling with the personal property. Now there's business personal property as well. The insurance companies limit it. Some are $1,500, some are $5,000. Anything that you derive income from would be considered business personal property. And so they want you to take out another policy, a business policy, so they can charge you more money, and certainly you'd have the proper coverage. So, but our argument sometimes is that maybe this computer in your home office is used 50% for personal reasons, and you can apply 50% of that over to the $900,000 base limit bucket. And so those have to be looked at critically. And the debris removal would fall in line as well. The debris field is not, again, just the dwelling. Now, under the personal property, there's two ways that they get settled: replacement cost or actual cash value. So the way this works is that a replacement cost value has to be established. So for example, let's use a couch. I'm going to use just ridiculous numbers. So let's say your couch to replace today. By the way, it's not what you bought it for. We're hearing a lot of adjusters say, asking what they paid for it. The insurance company wants to know. It's completely irrelevant. Okay, that's not how replacement cost works. It's what it costs today. No deals, no discounts. And you have to add tax, because you're going to pay tax to buy it. You have to add delivery charge, because you might have to have it delivered. You might have to have a warranty on it. and shipping costs, warranties, anything like that would add on to the replacement cost. So back to my example, let's say you have a couch today, and to replace what you had is $1,000 at today's price. It is subject to depreciation for wear and tear, age, condition, obsolescence, things of that nature. So let's say they take $300 off of that couch, and now you're at $700. So you get paid the actual cash value, which is the depreciated amount. This example is $700. And now you get that, and the insurance company is holding on to the other $300. Well, the question becomes, how do I get my other $300? Well, you have to replace it. You have to show them that you spent $1,000 or more to replace that which was gone, damaged. And then they will scrutinize the receipt and then pay you that $300 once you provide them with proof that you've replaced it. This is a cat and mouse game, folks, you do not want to get into. It'll take years off your life. It takes us, just to give you an idea, a team of somewhere between 5 to 7 people to handle one home. You've got the data dump, you've got all that information that has to be put on the paper. Then you have to go out and price it what it costs today to replace. And anything over $250, you need to provide some kind of evidence of where you're pricing it. Now, on top of that, the narrative of your personal property is important as well. Where do you shop? What is your buying patterns? How do you shop? Do you shop locally to support your local retailers? Are you an online shopper? Because as you know, the prices are completely different between those two scenarios. So it's really, really important to get the insurance company on the hook for what it costs today to replace. No deals, no discounts. Once that's done, then you have to minimize depreciation. Now, depreciation is taken for, like I said, age, condition, wear and tear, obsolescence. It's very, very subjective. Okay. The most important word I'm going to use here for personal property is condition. The condition of your items has the biggest impact on how much they're allowed to take for depreciation. And so remember, not only is the replacement cost of that item negotiable, that's the first step, getting them on the hook for that. Then the next step to handle this properly is to reduce and minimize the depreciation so that you're getting more upfront. So the same example, really quickly, $1,000 couch, they agree, it's $1,000, but the condition of the couch is in good condition or great condition because it's in a formal living room. And instead of taking $300 off, maybe they take $100 off. Now you've got $900 up front. What if you don't replace that sofa and you put the money somewhere else? So you've gained $200, they keep $100, it's done. The goal is to maximize and reach the limit of the policy. And how to do that is forensically. You got to count the toothpicks. It's the junk drawers. Everything matters. Every single item in that house that's gone had a value. Antiques appreciate, they don't depreciate. So anything that is 100 years or more would be considered an antique. So there's items that are paid on market value, whatever the willing buyer, willing seller would pay. So that's how actual cash value and replacement cost value work. Kenny, do you want to elaborate a little more on it?
Yeah, I was just going to mention, that example. And of course, a sofa is not going to cost $1,000.
Right. It was ridiculous.
Yeah, no. But I want to use that example. So,
Sure.
It's in a formal living room. It's an older couple, whereas a young couple with rugrats running around, that sofa is not going to last more than 8 years. So in that scenario, maybe you get paid $900 on an actual cash value basis. You may be able to buy that sofa later on sale for 30% discount and only spend $700. You're still entitled to the $900 because that's the agreed upon actual cash value. And so it's critical to get not just as high of a replacement value as possible, but to minimize the depreciation. And condition is huge because everyone has items that maybe 20 years old or 10 years, but they haven't even used them. You may have spare mattresses in bedrooms that your kids have been away for 10 years, and they may be 15-year-old mattresses, but they haven't been slept on in 10 years. So that is critical, and you want to count everything. The wooden hangers, the wooden shoe trees, it all adds up. And your tools, for example, in your garage, some of your tools may have lifetime warranties, Snap-on. Does that mean you depreciate them if they have a lifetime warranty? We're going to talk about additional living expenses next, but you're going to incur a lot of mileage now. Maybe you're further from work. Maybe you're further from dropping your kids off for school. That typically is made claim for under your loss of use or additional living expenses. Sometimes the mileage that you incur to go out and purchase items, maybe that's part of the personal property claim, or it's part of the loss of use. So everyone here, start keeping track of the kilometers that you're driving to get to different places, because you are entitled for any increased mileage that you're incurring.
So remember, replacement cost minus depreciation equals actual cash value. Everything's negotiable with an insurance company, everything. As long as you're operating within the four corners of that policy, you'll be fine. It's just understanding how to put them on the hook. Now, if you leave it up to them to price your stuff, they'll find it as cheaply as they can. So remember, it's your claim, your money, your house, your stuff. It's incumbent upon you to put it together. Kayla has another question, Kenny, but what I'm going to recommend, because Kayla, if I'm sure you can hear me, what I think would be best is if you could send us a copy of the policy you're referring to, and we'd be happy to look through it, so we can kind of give you the right answers and right advice. Kenny is a scientist with the wording, so we kind of look at it through a different lens. Would that be possible for you to PDF or email us the comprehensive policy? That would be really helpful, and we can have a discussion with you over the phone and answer your questions. Spend as much time as we need to with you on that, because it sounds like a very complicated issue there.
Yeah, and our emails will be at the end of the presentation too.
So Anita, I think, asked here, what if you don't remember the brand or items lost? Well, look for photos or anything that can jog your memory, and do the best you can. You'll sign a document that says, to the best of your knowledge, this is true, in fact, representation of what I lost, but I reserve the right to make further claims should the need arise, et cetera, et cetera. So it's important that you do the best you can. If it's a shirt, is it a silk shirt? Where do you buy? Where do you shop? And so maybe that'll jog your memory. I got a Dave C. I'm understanding correctly that the personal property amount is a max, regardless of replacement cost of our property. Well, it's not, Dave, because if you have single limit, you're able to expand the amount of the limit of personal property and move those numbers around if you have single limit. So hopefully you have that. But otherwise, if you don't have single limit, then the number is the number. It doesn't expand. Okay. So that's that one there. Okay. Okay. So thank you, Kayla. She's going to ask the landholder for the policy, and we'll be looking for that to come in. Okay. So Dave also asked, we have not suffered a loss, but are preparing for the next year wildfires. We're preparing a spreadsheet going room by room, detailing all property owned with photographs, invoices, etc. And I mean every item, forks, knives, etc. Is that a good enough start? Yeah, absolutely. Some of these people, when they got right before the evacuation, they videotaped with their phone. It doesn't have to be like, precise, because you're going to buy stuff, and if you don't have a loss, stuff comes in the house, it never leaves. Most of us never de-junk. But yeah, absolutely, that is a good start. And the most important thing is keep it out of the house. We've had people do that and document it, and then it ends up getting left behind and burns. Well, all the evidence is gone. So yeah, put it up in the cloud. That's always a good one. Or put it in a safe deposit box at your bank. If it's whatever you have, protect that. That's a really important document.
Except sometimes banks do burn down. Keep it in the cloud.
That's true too. Yeah, you're
Keep
right.
it in the cloud.
Let me look.
I think that's it.
I think that's it for now on that. Okay, so here's some common questions that we get on inventories. Do I need to list every item? Well, the question I have for you is, do you want to get paid for every item? And the answer is yes to that. List everything: toothpicks, junk drawers, all the stuff under the bed, all the stuff in the attic, the stuff in the corner of the garage that you never use for years. Now it turns into cash. So it's really important. How do I list every item? Well, you got to list where was it purchased to support the narrative of your shopping habits and how you buy. Remember, you're weaving a story basically to support your argument for the values. How much did it cost? That doesn't matter. It's what it costs today to replace. So does it matter? Yeah, everything matters. You're trying to maximize your recovery and in an equitable way, and you need to be honest. And as long as you're operating again within those four corners, you should be fine. But do count everything. We have teams of people that do it. It's quite arduous. Like I said, it'll take years off your life. What is a holdback and how does it work? Well, that was that example I gave you where the sofa was $1,000 and they depreciated $300. They're holding back that $300 until you replace it. Show them that you spent $1,000 and they give you that $300 back. That's how holdback works. And it's called depreciation holdback or withheld depreciation, that kind of thing. Condition is a factor in depreciation. We talked about that. Kenny talked about the difference between a formal living room or a mattress set that's barely used. An elderly couple may have it as a second home, vacation home, and really the stuff is in much better condition than a full family with 4 kids and 2 pets running around. So the condition is a factor in the depreciation, not just the useful life of it or how old it was. When do I have to replace? That's a good question. Some of these policies have a 1-year provision. That can be problematic because we all agree that you're not going to get built up within a year. You've got the winter coming in, and there's going to be delays. There's permits and architectural engineering to do, and so if you have a 1-year provision that they say you have to replace everything within a year, you can ask for an extension. That's step 1. Or step 2, then you're going to have to tell them that they're going to have to pay for all the storage and the shipping and all the costs, the ancillary costs that are involved in this provision. And so that becomes part of your claim as well.
Including the cost to move all the items from storage or from your temporary home back to the home when it is rebuilt, which may be even 2 to 3 years later. And we'll talk about suit time provisions as well. It's a lot, pardon me, it's a lot of work. And, Reno, we were talking before. I mean, one of the things that we do is obviously to take the burden off of your shoulders. We do, periodically we'll get involved even with the banks and finding out what the requirements are to deal with the building funds when they are issued. Most people only replace about 30% or less of what they had, and the insurance company knows it. So it's incumbent to get as high of a replacement value agreed to and to minimize that depreciation, because you're not going to replace every single thing that you had.
There's a couple of questions here, Kenny. I want to, in the effort of saving time. So how long do I have to reclaim holdback, Kenny?
Well, some policies are 6 months, some policies are a year. Intact's a year, but I will tell you that in the previous firestorm, we requested extensions past 2 years. They would not go past 2 years. And part of the reason for that is in British Columbia, the suit time provisions under the Insurance Act, as well as what's written into the policies, is 2 years. Which is the time frame you have to sue the insurance company if you are in disagreement on the settlement. And so they don't want to extend the replacement cost past 2 years. But some policies are only 6 months. We found a policy, believe it or not, it's crazy. It's written into the policy where a policyholder has to submit plans within 6 months of the date of the fire, or they only are going to have coverage for additional living expenses for 12 months. It's never seen that before. They have it. Now, we've asked for an extension on it because obviously there's no way to get plans even submitted in 6 months. They said they'll agree to it, but we haven't received it yet. So one of the things that is incumbent upon you as policyholders, and this is what we do, this is why we get hired, document everything you have in writing. Anytime you talk to the adjuster, follow up with an email, confirm everything. And you're going to be talking to the adjuster. He says, I'll get back to you. And then weeks go by and it just, it gets delayed further and further. You want to have an documentary evidence of everything that's occurred.
There's another question, and thanks for bringing this up. It was the trees. We never talked about the trees. So I have 10 acres of burnt trees. Under what category does this fall? We need to excessively log the property. So trees falls under the, and you'll see it in the policy, trees, shrubs, and plants. There is typically 5% of the base limit of the dwelling is the number that you would use, and that's the allotment amount, that's the limit of what you're able to collect for trees. Now, if you've got 10 acres of burnt trees, you're probably gonna exceed that number. And they usually have, it's usually $1,000 per tree, per bush, per shrub. And so that's what we call a low-hanging fruit. You should get that money right away. There's no reason the insurance company should hang on to that money. Ask the adjuster what you need to provide for you to collect that money right away. Remember, your money's worth more now in your hands than it is a year from now. So it's very important that you start to peel away these separate buckets of coverage and these ancillary monies so that you can start moving that money around as you need it. So again, with trees, it's usually 5% of the dwelling number, the base number of the dwelling. That's the limit. And then it's $1,000 per tree, per bush, per shrub. That includes the removal of the tree as well. So it's not a lot of money, especially people with acreage. We find that they're usually underinsured there, unfortunately. Hope that answers your question. Okay. So this slide's done. Can we talk about the next slide, please? So
I'll handle that, Reno.
Thanks.
So this is just two examples of 3 items. One where we just look at the age and the useful life, and another scenario where we enter condition, which obviously changes what depreciation should be. So we can give an example. There's a metal Henley dining table, and it's $1,500, and it's 3 years old. And this is a couple with kids. It's in their dinette. They'll be lucky if they get 12 years out of it. So we look at the age and the useful life, and it's 25% depreciation. And so that $1,500 table would be depreciated down to $1,125. If we looked at that same table and it was with an elderly couple without kids in the home, and it's in a formal living room, a formal dining room, then the useful life is going to go at least up to 20 years, maybe even 30 years. But if it's 20 years and it's in really good condition, well, now the depreciation goes from 25% down to 15%. And the actual cash value payment is now $1,275. And that same scenario you could apply to Rider jeans, where if it's hardly worn, obviously the depreciation goes from 50% based on those jeans being 1.5 years with a 3-year useful life to 1.5 years old, but with a 6-year useful life. And now the depreciation goes down to 25%. So if you look at the total actual cash value, when you don't list condition and apply it, it's $1,265. When you factor in condition, now it's $1,470. So it's important. In every item that we list, we put a condition code. And it's incumbent upon you to explain that to the carrier. No, my mattress is not 20 years old because my kids left the house 12, 13 years ago. I represented a couple, they were in their early 70s, retired accountants, both of them, worked for Fortune 500 companies. They had a home on the lake, and it was a vacation home. And they were there maybe 20% of the time. And the carrier, they brought out E-Justers. Many of you may be dealing with them now. And E-Justers went ahead, lowered their replacement value by 10 or 15%. And then overall, the depreciation was 48%. And they depreciated based on the replacement costs, but without sales tax, without delivery, without installation. So first we had to get the carrier to agree on the correct replacement cost. We told them we have to add in sales tax. Oh, no, we'll pay that when they replace. No, they're entitled to the sales tax when factoring in the actual cash value calculation. It's based on the cost to replace minus depreciation. And then lastly, I said to them, this home is only used 20% of the time. In that scenario, if something had a 20-year life, it now has a 100-year life. And they came back, they said, you're right, you're correct. They came back to 25% overall depreciation. I think we ended up getting it down to 18%, 15%. So there's a huge difference when it's a vacation home. It depends on, is it a young family with kids? Is it an elderly couple? Are the kids moved out? So condition is huge, and you want to get as much money up front on an actual cash value basis, because most people are going to only replace about 30-35% of what they had.
Good.
Any
Randy, Randy has a question. Can I assume with a seasoned dwelling, depreciation is less as it's only used half the time? That was exactly what you just spoke about. So hope that
Absolutely.
resonated with you. Yeah. And so the answer is yeah, it's less depreciation, of course. So the newer the item or the better condition it's in, the less depreciation they can take. Anita has a question. The property above was heavily damaged and all their trees are all burnt and in the soil. I am assuming it was comprised by the fire. I'm concerned with that land will slide once we get heavy rain or snow melts over the next years. My policy does not cover damages caused by landslide. Can I protect my property in the future? How can I protect my property? Kenny? I think that goes back to the retaining walls and foundations, et cetera, right? So you're right, Anita. Earth movement is an exclusion under these policies. Kenny, any suggestions on how she can protect the property in the future?
Well, that's an interesting question. So many of you may remember or heard about Santa Barbara and Montecito. About 3 years ago, they had massive mudslides. This is in California, which we also have offices. We're throughout the entire Pacific Northwest and British Columbia. And normally mudslides aren't covered, except in California, it's a proximate causation state. And lo and behold, the proximate cause was the fire that destroyed all the trees. So when the rains hit and the mudslides occurred and damaged all of their homes, it got covered. Now, I can't attest to British Columbia. It's probably something that may already have been tested, but it would have to be your trees that were damaged that caused the mudslide. Now, you may be able to collect for damages to your home if your neighbor's property causes a slide. You could pursue a liability claim against your neighbor. I can't specify whether it's 100% covered or not, but would certainly fall under a liability claim. You could tell your insurance company or tell him, I need you to do something to protect your soil. Or else, I may have damage to my home, and he could address it with his liability carrier. I wish I had a better answer for you, but if it's your neighbor's property, it's a little bit different scenario.
Next slide, please. So this goes back to the inventory tips and tools. Photographs, documentation, and cloud storage, really important. Family and friends at holiday events that you may have had a party where somebody has a photo on their smartphone. Any evidence, supporting what's in the background for your contents claim and to help you jog your memory is really important. Keep a pad and pen with you at all times, or even in your smartphone. You're probably driving down the highway and you're thinking about what what's happened, and oh, I had one of those, I had one of these, and it happens to everybody. So pad and pen with you at all times helps. Draw out each room one by one. Get a visual in your mind's eye. Walk through the house. Walk through the front door. Turn left. What's there? Is there a wall? Is there a coat rack? What's on the right wall? What's ahead of you? And so in your mind's eye, you're trying to visualize everything. Draw the bureaus out, the closets, etc. This really helps people recollect what was there. It's a daunting task. We actually patented a memory jogging system that we use in an effort to assist our clients in remembering what was in the house. Don't forget what was under the beds, dressers, etc. Things that we stuff and hide up in the attic. All the things that we're not using, or currently or haven't used in years, that we hide away and we haven't dejunked. That's now turns into cash. So remember, don't forget that stuff. Use family and friends. Let them help you do the research. So if you make your list and it's 2,000 line items of stuff that you lost, and you have to price it next, and that's a daunting task, rip off a few pages and give it to your relatives. See if they'll help you with that, or your friends. That may help. And then the memory guide is what I just talked about. We have this memory guide that we use in an effort to help you recall what was in the home. It works more often than not because we handle so many firestorms that we've developed this system that really helps tremendously. Next slide.
Reno, I was just going to comment. I think over the years we've handled probably over 1,000 firestorms, and so our memory guidebook that we have, it's typically 140 pages. It really helps. And I don't know if you mentioned, Reno, but when we do these inventories and we bring in all these different people, you'll have a dedicated person that will sit down and recreate specific rooms that you don't have photos for, that and may reflect items that aren't in the memory guide. And everyone's different. Some people like to do a recreation. Some people like to use our memory guide, and I'm going to do homework and I'm going to go through the memory guide. So it's all different, but we certainly accommodate your schedules. If you're doing this on your own, take your time. Don't rush it. The e-justers and some of the other entities, they want to meet right away. They want to meet you. They want to go through everything, and you don't want to rush it. You just don't want to rush it. Take your time.
Yeah, we do it in slivers of time. That's when you will be more relaxed. And look, the other thing that we see a lot is on this inventory topic is, we sit down with somebody and we say, we're going to dedicate 3 hours to this today or tonight, whatever. And suddenly you get to the part of the house that has some sentimental items and you glaze over, and that's it. I mean, you're done. You have to reschedule. And so do it in slivers of time. Kenny makes a good point. Take your time. This next slide, let me just check to see if there are any questions on that. And it looks like no. Okay. Next slide, as you can see, talks about your loss of use. This is the fourth and final bucket of coverage. Look, if the house is uninhabitable, whether it's a smoker, meaning it's all smoked out, or it has perished, this bucket of coverage strictly pays for you to live elsewhere during the period of restoration or reconstruction. The key word in this clause is that your standard of living is to remain the same. No more, no less. And so if you don't have single limit, this is a lose it or use it bucket. of coverage. So you want to be comfortable. This is a marathon, not a sprint. These claims take a long time. The insurance companies drag their feet. They can make you desperate. And so if you're in a suitable housing environment that you're comfortable and safe in, it helps. It takes that other mental load off of your brain. Now, what does it cover? So certainly it covers the same standard of living to lease or rent a similar home. It also covers the loss of rental income. If you had a portion of your home that was rented to others, then it also covers that loss of rental income. Some policies have a limit of only 12 months on that particular benefit. But the loss of use coverage for you is to the either to the dollar limit. In this example, once they paid out $360,000, assuming you don't have single limit coverage, then that's it. They're off the hook. And then you're stuck paying the mortgage and the rent. You can go belly up pretty quickly. So you got to be careful on this bucket of coverage. Now, not only does it pay for the lease and the rent of a temporary home or dwelling or condo, whatever works, but they also have to rent you furniture. We met a couple early on when the firestorm hit. The adjuster told this elderly couple that they said, "Hey, we found a home, but it has no furniture. So, we need furniture." And the adjuster said, We don't do that. We don't pay for furniture. Well, what are you going to do? Sleep on the floor? So it is covered. So the rental of furniture, you want to lease the furniture. You don't want to buy it. You want to lease it and use the benefit because you don't know what you're going to redecorate or rebuild like when you go back. So there's no sense in buying your furniture for this temporary living arrangement. Animal boarding is also covered. RV boat storage, boats or RVs that need to be stored, that's covered under this bucket of coverage. Extra kilometers, like Kenny mentioned earlier, is also covered. And you want to make sure, again, that your same standard of living is met. Now, some people have opted, we've got clients currently in West Kelowna that have opted to live in a smaller place to extend the time frame. They only owe you for the shortest period of restoration. So once you get that check to start the rebuild, the clock starts to tick. And make no mistakes, they want to stop the bleeding. The insurance company wants to stop the bleeding in this account. And so they want to shorten that period of restoration. So you got to be very aware that let's say 5-6 months from now, you get a check to start the rebuild, but you're stuck because of the weather, the permitting process, whatever. They're gonna try to shut off this bucket of coverage in an effort to save money. Look, the insurance companies are a for-profit business. Doesn't make them bad people, but the more they pay you, the less they have. And so so it becomes a problem there where they're dictating what they want to pay. They wrote the rule book, but you really got to understand how the rules work. Yes, Kenny.
Yeah, I was just going to add, I think, if you're not sure you're going to rebuild, don't tell the insurance company you're not sure you're going to rebuild because they owe you for the shortest time. And if you're going to replace and you tell them that right away, then they're going to start saying, well, shouldn't take you more than 6 months to replace. Now, of course, you can't really replace without knowing your budget. So I think for those people, unless you're 100% certain and you want to share that, you're planning to rebuild, can't make a decision until I know what I'm going to collect. And you go down that road.
That's a great point, Kenny. Randy has a question. My loss was a secondary home, a vacation home. Since I cannot use it for a vacation, do they owe me me a vacation since it will take more than a year to rebuild? Kenny?
Yeah, that's interesting. We ran into that. You may have seen the email that I had sent out with to Bill. So Intact has what's called a seasonal home. And the adjuster was initially suggesting, well, we don't owe for living expenses because they're staying in their primary home. She wasn't entirely wrong. Some carriers have taken the position, oh, but you only use that 6 months a year or 3 months a year. So we'll just pay you to rent a home for 3 months or in the summer. Well, most people that have a year-round home, they don't just go up there in the summertime. They'll use it over the holidays, over Thanksgiving, or maybe just one weekend go up. So I believe you're entitled to rent a home for a full year, because you may not be able to find a home for just 3 months. Most homes that are being rented, they want a 12-month lease. And the beauty is, unless your home couldn't be used in the wintertime and you used it periodically whenever you wanted to, I think you're entitled to rent a temporary rental home for the next year or two, or however long it takes to rebuild your home. I'm just curious, has the insurance company told you that you're not, or or have they said, we'll consider it when you incur it? Because typically you have to incur it to get paid for it.
Dave has a question. If you don't want to rebuild, what happens? Do they calculate the cost to rebuild and pay you that? Or are you forced to rebuild and then sell that house? It depends on the policy, Dave. You can opt for what's called an actual cash value settlement. Certainly that's one option, but to maximize the benefits of that policy, typically, the replacement cost benefit or the guaranteed replacement cost, and all these single limits that we're talking about, all those benefits are typically if you do rebuild. Now it's up to you. We have some people in the area that don't want to rebuild in an ashtray, and they don't want to put that money in, so they opt to sell, get rid of the debris, sell the lot as a buildable lot, and take the insurance proceeds. Again, you can cash out. That's called a cash out. But based on how your policy reads is how the narrative will be, or how the claim is prepared and presented. Ken, do you want to add on any more to that?
Yeah. So, it depends on, Intact has a lifestyle endorsement.
Right.
It really depends on your coverage, single amount, guaranteed replacement cost amount. And by the way, a lot of these policies talk about with guaranteed replacement, you have to rebuild at the site, but you may decide based on the settlement, you can always, and if it's just a single limit, or if it's just the dwelling coverage, you don't have to rebuild at the site. You could rebuild somewhere else. They owe you for the cost to put it back the way it was at that site.
Hope that answers your question. Next slide, please. Thank you, Christine. Let me lower this screen here. So these are two examples of under the loss of use that can happen. Additional living expenses is what the ALE is what they usually call it. Again, that pays for your temporary housing. We've had some firestorms in California where people went off and purchased a home because there was no more housing. You got 2,000-3,000 homes that disappear, and there's a run on housing. So they went out and bought a home, and they still were able to collect money for that. It's a little complicated, but that can happen. Furniture rental cost, of course, is covered. The increased kilometers is covered, as we mentioned. Animal boarding, dollar limit, time limit. Some policies have a time limit. Some policies have a dollar limit. Most here in British Columbia have a dollar limit. In the States, we see time limits no more than 24 months or 36 months, and then you're done. Fair rental value, you might want to look at, remember, everything's negotiable, right? So you might want to look at what would your home have rented for, fully furnished with all its amenities, and that'll be a number. And it's based on comps. And once we have that number, then it's presented and say, hey, this is what's fair and reasonable as a number established for what I had. And so that's how the fair rental value approach is taken. Rental income collected from any tenants, like we said, if you had a room or two or a lower level that was being rented out, and of course that stops, so that loss of rental income is covered as well, up to whatever the time limit is in the policy or the dollar limit, and it's part of that loss of use category. Yes, Kenny.
Yeah, I was just going to add two things. With if it was a rental property, the carrier is entitled to a discounted payment if there's certain expenses that don't continue. So, for example, you were collecting $3,000 a month in rent. but you as the landlord were paying utilities, and now you're going to get paid $3,000 a month in rent, but you no longer are paying utilities. The carrier is entitled to a credit back for what those utilities are. With respect to the additional living expenses, some people don't want to rent a home, but they ask, well, can I get paid? What can I get paid? Most of the carriers won't agree on a monthly payout unless you're incurring living expenses. But some people want to be back at their site. They may have a farm. They may have horses that they're dealing with, and they want to be there. Many times we've been able to get the carriers to give consideration for a double wide trailer if it's going to cost, $5,000-6,000 a month for the next 2 years. It may be a lot less expensive to just put a double wide up there, and then they're able to take care of any animals and to be at the site during the reconstruction. So in many respects, everything's somewhat negotiable. And that's something that some of our clients have been looking into, and we're working with the insurance company for them on that matter.
I don't think there's questions on that. I'll double check before we move on. I don't see a new question. Okay, next screen. Thank you. Kenny, this is you.
Sure.
This will be our last screen, folks, and then we'll have our information up on the next screen with our emails and phone numbers. Kenny, you want to talk about this?
Sure. We talked earlier. So again, most of the policies have either 6 months or 1 year to replace the personal property. It can't be done when you have, 200 homes that burn down, or even when your home burns down completely in a non-firestorm. So you obviously ought to bring it up now. Tell them there's no way I can replace it. I'd like to get it extended at least 2 or 3 years. You can ask 3 years, they won't give it to you, but certainly ask them to extend it, because there's no way you can do it. And they don't have to extend it. They may say, well, let's see what happens. And if they say, well, we're not going to extend it, then you need to put them on notice. You're going to have to rent storage units. You're going to have items delivered to it. They're going to pay for the cost of storage for the next 2 or 3 years, and they're going to pay for the cost to move everything. The second and most important thing to be aware of is the suit time provision. In British Columbia, you only have up to 2 years from the date of loss to file suit if there's a disagreement with the carrier. Now, here's the problem. You may not have a disagreement, or that disagreement may not occur until after 2 years, because you're still dealing with the rebuild of your home, because you're still trying to negotiate the personal property. And then after 2 years, you find out, well, they're not going to pay me $100,000 because they don't think these repairs are covered. You're not protected because you didn't file suit within that 2-year time frame. It's not a major ordeal. A lot of times, our policy holders, our clients have put together and filed suits. They didn't serve it to the carrier. They just filed it in court to protect their rights. Costs $2,000-3,000. Any attorney can do it. And it's really for your protection to keep the claim going. The carriers don't react unfavorably to it. They understand there's a 2-year time frame, and if the claim hasn't settled, you're doing it solely to protect your rights. But you do want to do it. Even if you're 90% through your claim, you may have a $50,000 issue. It's worth spending $3,000 to file suit to protect your rights.
Yeah, it just keeps the door open, folks. That's all it does. It just keeps that door open. You don't want the door to close on you. Any questions on that? Our next slide will have our information on it. I would encourage you to either take a screenshot or write it down of this information. What I would recommend is, for those of you like Caleb that have some complex questions, we'd be happy to talk to you. There's no cost, no obligation to have an informative phone call or a meeting or a Zoom call to go over the policies in detail. We'd be happy to do that to see what makes sense and what doesn't. Sometimes it does make sense for us to jump in and represent your claim. Other times it doesn't. We'll be the first to tell you either way. But there's no cost, no obligation to talk to us, certainly. So that's our information up on the screen. Is there any other last minute questions that anybody has? I do want to mention, Wendy, did you want to add anything to the meeting?
Hi there. Oh, thanks. Thanks for that. I think what's really most important from our perspective is to really understand your policy. And I have to say, what I keep telling people is you don't know what you don't know. So if you don't understand the policy, it's pretty hard for you to hold the insurance carrier accountable and pay you what you're owed if you don't understand that. So my overarching advice is make sure, however you do that, whether it's yourself, a friend, a family member, or Greenspan, to make sure you're well educated about what your policy covers and what it doesn't. Because in our personal experience, I will say strongly, the insurance company doesn't come forward and say, oh, and by the way, did you also know we're going to cover this? And we could also cover that if you need coverage for that. They don't do that. They don't offer. They wait for you to understand what your policy covers and to come to them with a claim. So it's really, really important that you are well educated. And if you don't know, you don't know. So it's really important to try and make sure you well position yourself so that you understand what you're entitled to and what you're not.
Thank you, Wendy. Knowledge is power, people.
Absolutely.
The more knowledge you have, the better off you're going to be if you're going to try to deal with this on your own. Just so you know, I'm in Kelowna almost every week. So more than happy if someone's local and they want to meet, we can do so. I may even be heading up to the Shuswap area in the next couple of days as well. So just wanted to throw that out there.
I think there's a question.
And Reno's going to be around as well. So
Yeah.
we can make ourselves available.
So Allie has a question. Our policy's up for renewal. Can we make changes without it affecting the claim? Yeah, of course. The claim is a snapshot in time. What was the contract language at that moment that was in place when the event happened? So whatever happens moving forward or behind is irrelevant. It's a snapshot in time. You can certainly make changes on your policy. If you need some advice, feel free to reach out to us. We'd be happy to kind of guide you through that.
Reno,
Well,
I want to add one other thing though. Here's what's important, and maybe Wendy's already going there with it. Allie, if your home burned down, and you're thinking, well, I don't need property coverage, don't remove the property coverage. Keep it going, because one, it covers you for personal property that is at a rental home where you're at. Two, you don't want to stop the coverage and not even insure, because you're going to need that coverage when you rebuild. And lastly, if you decide not to renew, you may have trouble getting coverage later on. So I would advise you that even if your home got destroyed, continue paying the premium, continue with the same coverage you had before.
Wendy, did you want to add something?
Yeah, that's exactly right. I know when we had because our house burned down, will be 2 years ago in December, almost a year ago, last November, we received our renewal. And I was like, why would I pay $3,000 a year for a home that doesn't exist? All I have is a plot of land and no home on it. So I called the insurance company, and yes, you have to keep it going because they will cover the rebuild process. Otherwise, and in fact, that was way cheaper than buying construction insurance, because the construction insurance costs us about $8,000 or $10,000, and the renewal policy is only $3,000 a year, which also covers our contents. Construction insurance does not. So it's really important that, again, you ask lots of questions, because part of me was just like, oh, I'm just going to throw this in the garbage and not pay attention to it. But of course, Greenspan says, no, don't do that. So we made sure we did the right thing.
Plus, you have liability coverage, right?
Yeah, liability as well. You want,
Yeah.
And you know, since Wendy's here, I will share with you that, you know, I always say that, and I've been doing this a long time, insurance companies are penny wise and pound foolish. And a perfect example is we got our estimate submitted within 3 months of our retention. I think it was about 3.5 months. And that was for Wendy's claim. And they dibble-daddled for almost 9 months on just the foundation because they thought that the foundation was salvageable. And then it took them another 3 months or 4 months to get their estimates put together. Our personal property claim, Wendy, it was submitted 8 months ago, I think.
Last October, so it's been a year.
It's been a year, and they're now just getting back to us on wanting to find out about certain items that are listed. You know, you got to keep the pressure, document the file, be relentless, and it's almost a full-time job. It's almost a full-time job.
There's a last question here. Justin writes, thank you so much for all the information. Very helpful. Will there be another information session in the weeks to come? We're going to be discussing that internally to see, you know, resources available. I don't see why not. We do want to reach as many people as possible to give them the information that we shared with you this evening. And if you know anybody, a neighbor, a friend, a cousin, whoever's been affected by this wildfire, please provide them our information. It doesn't cost you anything to have a conversation to see and explore what makes sense and what doesn't. If engagement makes sense with us, after we talk about it and look at the policy, we work on a small percentage of the settlement. It's a contingency fee. We get paid on the back end of the claim. As you get paid, we get paid. We're incentivized to maximize the recovery. So everybody on our team, this is an owner. We all own the company. It's an employee-owned operation. So everybody's got skin in the game, which is very important. We're not just some people working out of a car. The more you look into us, the better we look, I always say. And so we encourage you to do your research. Give us a call. Let's have a conversation. See what makes sense.
Yeah. Some claims will make sense to us, some don't, but we'll certainly give you answers and give you some more information that you didn't have prior to talking to us.
And that goes for anyone that's on the call all over British Columbia. I actually live in White Rock here as well, so I'm right by the Vancouver office too. So we're here and happy to help you.
With that said, we're going to wrap it up. Let me just check one last time. Yep, there's no other questions. I want to thank everybody for their time this evening, and hopefully it was informative. Please spread the word and reach out anytime. We'd be happy to talk to you. Again, no cost, no obligation. Okay?
Take care, everyone.
Thank you, Christine, Wendy, Reno. Thank you. Great job.
Yeah, thank you. Take care, guys.
Take care, everyone.